10 investing lessons I wish I learned sooner. What if I told you that the biggest investing mistakes aren't about picking the wrong stocks, but about getting the fundamentals completely backwards? Today I'm sharing the 10 investing lessons that took me years to learn. Lessons that could have saved me thousands of dollars and countless sleepless nights. Stick around, because lesson number 7 is going to completely change how you think about risk. Hey everyone, welcome back to the channel. If you're new here, I share practical investing advice to help you build real wealth without the Wall Street BS. Before we dive in, make sure to hit that subscribe button and ring the notification bell. Trust me, you don't want to miss what's coming up. Lesson 1. Time beats timing. The first lesson that would have changed everything for me. Time in the market beats timing the market. I spent my early investing years trying to find the perfect entry point, waiting for crashes, analyzing charts until my eyes hurt. Meanwhile, my friend Sarah just kept buying index funds every month, regardless of market conditions. Fast forward 5 years, her boring strategy had outperformed all my clever timing attempts. Here's the math that'll blow your mind. If you invested $500 monthly in the S&P 500 starting in 2000, even through the dot-com crash and 2008 financial crisis, you'd have over $300,000 today. The key isn't when you start, it's that you start. Lesson 2. Compound interest is magic, but only with patience. Einstein supposedly called compound interest the eighth wonder of the world, and now I understand why. But here's what nobody tells you. It's boring for the first decade. I remember checking my account balance obsessively in my 20s, frustrated that my $1,000 was still just $100 after a year. But compound interest is like a snowball rolling down a mountain. It starts slow, then becomes unstoppable. That same $1,000 invested at 8% annual returns becomes $2,150 after 10 years, $4,661 after 20 years, and over $10,000 after 30 years. The magic happens when your returns start earning returns. Be patient with the process. Lesson 3. Diversification isn't just about stocks. I used to think diversification meant owning Apple, Microsoft, and Google. Wrong. Real diversification means spreading risk across asset classes, geographies, and time periods. When tech stocks crashed in 2022, my portfolio barely flinched because I had international stocks, bonds, REITs, and even some commodities. Here's a simple framework. 60% stocks, split between US and international. 30% bonds, 10% alternatives like REITs. Adjust based on your age and risk tolerance, but never put all your eggs in one basket, or even one country's basket. Lesson 4. Your biggest enemy is your emotions. This one hurt to learn. In March 2020, when the market crashed 30%, I panicked and sold everything. I watched from the sidelines as stocks recovered and hit new highs. That emotional decision cost me over $15,000 in missed gains. Fear and greed are wealth destroyers. When everyone's panicking, that's often the best time to buy. When everyone's euphoric, that's when you should be cautious. Create rules for yourself and stick to them, regardless of how you feel. Automate your investments so emotions can't derail your strategy. Lesson 5. Fees are silent wealth killers. A 2% management fee doesn't sound like much, right? Wrong. Over 30 years, that 2% fee will eat about 1/3 of your returns. I was paying $2,000 annually in fees on a $100,000 portfolio without even realizing it. Switch to low-cost index funds. Vanguard, Fidelity, and Schwab offer excellent options with fees under 0.1%. That difference between 2% and 0.1% in fees could mean hundreds of thousands more in your retirement account. Every dollar you pay in unnecessary fees is a dollar that can't compound for your future. Lesson 6. You don't need to be an expert. I wasted years trying to become the next Warren Buffett, reading annual reports, calculating price-to-earnings ratios, analyzing balance sheets. Meanwhile, a simple 3-fund portfolio was outperforming my stock-picking attempts. Here's the truth. You don't need to be an investing genius. A total stock market index fund, an international index fund, and a bond index fund will beat 90% of professional fund managers over the long term. Keep it simple, keep costs low, and let the market do the heavy lifting. Lesson 7. Risk and volatility aren't the same thing. This is the game changer I promised earlier. I used to think stocks were risky because they went up and down. But volatility isn't risk, it's just price movement. Real risk is losing purchasing power to inflation or not having enough money for retirement. Historically, stocks have been the best hedge against inflation over long periods. Yes, they're volatile short-term, but over 20-plus years, they've consistently outperformed bonds and cash. Don't confuse temporary price swings with permanent loss of capital. Lesson 8. Start with what you have. I spent months researching the perfect investment strategy before investing my first dollar. Analysis paralysis is real, and it's costly. You don't need $10,000 to start. Many brokers now offer fractional shares, so you can begin with just $1. The best investment strategy is the one you actually implement. Start with what you have, even if it's just $50 a month. You can always optimize later. The opportunity cost of waiting for perfection is enormous. Lesson 9. Automate everything. Willpower is overrated. I set up automatic transfers from my checking account to my investment accounts right after payday. This pay-yourself-first approach removes the temptation to spend that money elsewhere. Automation also helps with dollar-cost averaging. You buy more shares when prices are low and fewer when prices are high, smoothing out volatility over time. Set it and forget it. Your future self will thank you. Lesson 10. Invest in yourself. First, the best investment you can make is in yourself. Early in my career, I spent $3,000 on a professional certification that led to a $15,000 salary increase. That return on investment was immediate and permanent. Whether it's education, skills, health, or networking, investing in yourself typically yields the highest returns. Once you're earning more, you can invest more. It's a virtuous cycle that accelerates wealth building. Conclusion. These 10 lessons would have saved me years of mistakes and thousands in losses. But here's the thing. You don't have to learn them the hard way like I did. Start implementing these strategies today, even if you're just beginning your investing journey. Remember, time in the market beats timing the market. Keep fees low, stay diversified, control your emotions, and never stop learning. The path to wealth isn't complicated, but it does require patience and consistency. If this video helped you, smash that like button and subscribe for more no-nonsense investing advice. Drop a comment below. What's your biggest investing lesson? I read every single one. And if you want to dive deeper into building wealth, check out my playlist on index fund investing linked in the description. Until next time, keep investing in your future. I'll see you in the next video.